Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Matt Amberson is among those who have watched the steady and consequential evolution of the listed equity options market over the last 3 decades. Getting his start on the floor of the CBOE in the 90s, he was in the trenches during the period of incredible single-stock volatility that was tied to the original tech bubble. While markets were not nearly as efficient then as they are now, Matt sought to improve his edge in trading options, seeking enhanced methods for estimating a stock's volatility and searching for instances where the market may have left value undiscovered. Using proprietary option valuation and hedging techniques, Matt backed traders who were tasked with implementing this systematic approach some 25 years ago. And while those are days of the past, the IP developed lives on in the form of the company founded by Matt, ORATS, Option Research and Technology Services. Throughout our conversation, we learn about the growth of the U.S. listed options market and how Matt and his partners have developed their data analytics and option backtesting service. In the process, we consider risk events like GME, and hear Matt's perspective on risk management protocol in light of the increasing frequency of upshocks in stocks. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Matt Amberson. My guest today on the Alpha Exchange is Matt Amberson. He is the founder of Options Research and Technology Services, also known as ORATS. Matt, it's great to connect, and thanks for being a guest on the podcast.
It's surreal to be here. I love your podcast, listen to all of them. Honored to be a guest here, Dean.
Well, you're very kind. I'm eager to have this conversation as well. And a lot of what we do in this podcast is explore the world of market risk. We do it very much through risk events and through optionality, which is sometimes at the scene of the crime for some of the big risk events. But you've done some really interesting stuff here just with your background in equity derivatives, but then bringing it all together with this great technology and backtesting service of ORATS. So let's get into it. Let's learn a little bit more about you and your background. Tell us about the early days for you, how you got started in the industry. Tell us.
My family was very interested in investing. My dad would match my paper route money in my brokerage account, and I learned how to invest. I actually traded a warrant, so I guess that was my first option in the 70s. You used to have to look in the paper back then. And then I got a job at Lehman Brothers, which many of your guests have had when I was a red shirt in college. I would go down there at 5:30 in the morning, and whereas I think you were friends with the copy machine, I was friends with the dot matrix printer, and I would bring the bond reports across downtown LA. If I got done in time, I'd try to find a couch in the Bonaventure and take a 20-minute nap before the security guard caught me. And then did running, cold calling and stuff. So that's my Lehman story. And then when I was in college, took a basic programming class and did a project and then just picked something randomly, training times on horses. I'd never been to a horse race and learned I just got totally addicted, wrote this whole regression analysis for horse racing that actually worked pretty well. And loved it and used that well in my finance, and then eventually got accepted to Kellogg in Chicago, went back there and was a derivatives consultant out of the gate after graduate school and saw Chicago Research and Trading, CRT, and a lot of the great firms back then. We got an inside look at it. They would audit them and I would do the valuations of the options. And then during tax season, they'd ask me to help out. And then I saw the crazy numbers that even some of the individual traders were making. And so I quit the accounting firm and went to the floor as an option market maker and was successful down there and hired some people to help me out. We developed some ways at looking at volatility that were somewhat different than other people. I noticed that our close-to-close volatility on some of the stocks that I was trading weren't really representative of the implied volatility that we were buying and hedging. And so we developed this historical volatility calculation that was based on tick volatility and simulating gamma scalping and turning that profit into a HV. And so my Nextel stock that I was trading that was implied at a 50 and close to close said it was about a 50. Actually, we thought it was about a 54. So we started to do those calculations. I started to back people. I got up to about 14 people backed across the floor using our forecast, the ways that we summarize skew. And then I got married and it got tougher to trade, and we started ORATS. A lot of the people on the floor and the trading firms were our first customers. That's a brief, or maybe not so brief, background how I got into the business, Dean.
Well, this is really interesting. And so there's a lot for us to run with here. So, first, just in terms of the proximity of time when you were first starting to trade equity options on the floor, is this kind of early 90s or what time frame are we looking at?
Yeah, exactly. When I first realized how much money they were making, I got an account, my brokerage account, and started trading options in the early 90s. And I went on the floor in 93 and stayed there till 2003. So those were the heyday of trading, of individuals could still go down there and be an independent market maker at that time.
It sounds as if some of what you observed, just in terms of the math of the calculations of, let's say, close to close vol, potentially underrepresenting the true value of optionality. I'd love for you to talk to us a little bit more about that. And then just in terms of maybe the philosophy that you use to back these 14 traders, be great to learn more about how you implemented that and just the concept of backing traders, to learn more about that as well.
Yeah, I should say that the close to close versus our tick volatility wasn't always over. As a matter of fact, it was rarely over. So when we found something where it was over, like in my Nextel high flying NASDAQ stock, where it really moved around a lot intraday, those are the places I would put traders in because it was my money backing them. And so I had them on a short leash, let's just say. It was really interesting because we would download all this tick data. We would simulate what we were doing on the floor, scalping our gamma, and we would compare our results with the tick data results. So we really had real world against our tick data results, because if you didn't adjust some of the bad markets, you would really get some skewed results, wrong results. So we had a comparison that we could make, and we would give them different scalping intervals. We would say quarter of a standard deviation all the way up to 3 standard deviations. For example, like IBM, we found out was best just to let it run. Whereas Nextel, you wanted to scalp it as much as you could. We found certain things like that that really helped us out. And that really had an effect on the close to close versus the tick vol. And we've carried that into ORATS even now. And that's how we would put people in pits, and then we would really manage them closely. We would download a lot of data. We would be the last ones to leave. We would review all the trades and what your delta was and why you did this and why you did that. It was quite an interesting time back then. We learned a lot, and then I would hire PhDs to come down. The most dangerous people were people that already had an opinion, that are already traded. So I like to get very green people, put the fear of the market in them. Those were generally my best traders. So that was a bit of the strategy that I employed down there, Dean.
It sounds to me, as you back these folks, that the goal was to really have them implement something very specific and to be relatively robotic about it, to try to not have too much discretion in decision making. Is that fair to say?
Well, you're describing Timber Hill back in the day, and Timber Hill was really good at that, but they'd have guys that really didn't understand what was going on. So we had kind of a blend of that. Timber Hill was interesting because they wouldn't trade with us anymore. They knew the people to trade within the pit and then the people not to trade within the pit. So they had an interesting way of approaching it. But we gave them some discretion, but we watched them very closely. There's so much going on in the pit, so much information in options, as you know. So we tried to give our traders enough to act on their intuition, but also we gave them a lot of tools to look at skew. For example, we use delta on the axis where some people might just use price, so we could communicate skew. The nice thing is that we could communicate what's going on in related stocks and related pits that we were seeing. So we all would talk upstairs afterwards. And so it was a very good way for independents to be able to understand what's going on in the broader market and not just get pigeonholed into the pits that they were in.
I'm struck by just the degree of evolution in all this stuff. And perhaps the US listed options market is just a regular example of just how things get to be more efficient over time. But boy, if you step back and you go to the mid 90s and think about the bifurcation of floors, the liquidity that really existed on one floor versus another floor versus another floor. And now just the speed with which prices are displayed and transmitted and executable in an instant, all electronically. I'd love for you to talk a little bit about the politics of getting trades done back then. They're very different now because you're facing effectively some bot of capital, but then you had to have a lot of human interaction. And you were just pointing to something where Timberhill wouldn't trade with you because they thought you had certain information advantage, perhaps that other counterparties didn't. What are a couple of the just things you would remember about the politics of getting orders done successfully in an era where it was all kind of hand-to-hand combat?
Yeah, I mean, you make a great point. I often think if I had all the data that I have now, we would make so much money back then. But that's the point, is that you can't have all this data because we were trying to develop it back then. And so all the information, and now the markets are much tighter. Clearly, back then, skews would get off and points would get off of the skew. Because as a market maker, you would get a feeling for when someone had to come in and get out of position. So you could still do things like that. And there's none of that really, or it's, if they're doing it now, it's very quick and bot related, as you say. But the evolution of how trading was done back then versus how it's done now, it's almost night and day. And in a small firm like mine, we could do okay in that. But now the market making firms and the trading firms, they have so much data behind them. We have some huge hedge funds that come and just buy all of our data, and they put it right in their AIs and finding all these relationships. They have thousands of people working for them in some cases, and it's tough to compete against. And that's what started to happen. That's when it started to get real difficult, when it was, like you say, priced on different exchanges, and then these off floor, the technology and the data, they just learn so much, and you just have to have a healthy respect for how smart some of these trading firms are. So it's just was a lot different. Investing's tough. There's just so many smart people now, and the data's now available. Whereas on the market back then, you knew so much about your stock. You knew how the skew changed seasonally, for example, what would happen during earnings events. And now that's all kind of data related.
What are some of the dislocations that came about, let's say, again, during the mid-90s, before really the markets got very, very electronified in terms of access and ability to trade? But if one, either part of the vol curve or one asset became either rich or cheap to another, what are some of the circumstances that tended to bring that about? And then how would a firm like yours identify an opportunity like that?
Yeah, like back then you could have Microsoft, the skew went from a normal skew just to inverted because one big trade over 20 days, we were able to see that in real time. But even though there's a dislocation there, you couldn't trade a related stock because that skew might not come in. So you had to decide, is this a market-wide phenomenon that's happening, or is it something specific that's going on in a particular stock? Like there were some crazy stocks like eToys, for example. We had a market maker in eToys, and I was out with one of my old graduate school friends, and he goes, that stock is worth 0. And it was like trading 80. So how do you protect yourself on these stocks back then that were so overvalued? We're kind of seeing that sometimes in the market now. So we had meme stocks back then, and the skew would get out of whack, but it was very difficult because some of these meme stocks just, they traded on kind of their own schedule. And you had, when the people could sell their stock, that would make it much more volatile, as where it just kind of drifted up the other days. So it's hard to put that in one box, because that's where I think you really needed to have your traders understanding the flow and seeing that back then how it worked, because some of these are stock specific and some of these are wider. And luckily we could see that. Like back then you could hear the whole floor kind of getting quieter, and then volatility would come in that day. We were able to communicate that if we saw it generally, but then you'd have these specific events in these specific stocks that were, you'd really have to be on your toes in order to trade those well, Dean.
You mentioned Microsoft, and of course that was always just an incredibly deep single stock option. Just as we think about dislocations in names, there were two specifically in Microsoft that I can recall quite well. One was the skew got really, really steep on the back of the Paul Allen collar. One of the co-founders of Microsoft did just an absolutely giant collar. So bought, put, sold, call, and just left the street with lugging a lot of skew risk. And so the street was really, really bid to buy some of that back. And so that skew got enormous relative to what you would think it should be and relative to kind of other comps. And then the second one was really interesting as well, was when Microsoft decided to allow its employees to monetize their employee stock options. They worked with JP Morgan and essentially sold vol to JP Morgan. They sold these options to JP Morgan. JP Morgan's left with what they thought was cheap vol, but they bought so much of it that as they started to push it back into the listed options market, Microsoft vol traded, I want to say 1 point over S&P vol at some point, got really, really cheap. So I thought that was just interesting just in terms of dislocations. You talked about meme stocks back then and eToys. So I'm hoping you can share with us some of your experience through the original tech bubble. Let's call it that. Call it 96 to 2000 type of era. There was a lot of stocks up, vol up behavior back then. I'm sure you were involved in a lot of hairy situations. What are some of the behavioral characteristics you can recall from that period in the listed options market?
Yeah, you mentioned that Microsoft trade. That I was on the other side of both of those. So those were painful events, not just interesting events. Like I said, some of these meme stocks back then, it's happening again. So what would happen is the skew in those would go to the calls. And we saw that happen. One of the metrics that we have at ORATS now is a component-wide average of the skew. So what we saw happen recently with GameStop and AMC, for example, it hasn't reverted. Retail has really changed the look of the skew. Well, that's what happened back in 2000s too. The calls just got bid, and like you said, vol up, stocks up, and you really had to be careful on how you were trading back then. And that's what happened back then, and that's what's happening now. So I do think it's very interesting.
Yeah, and that period for the U.S. listed options market back in the turn from the 90s into the 2000s was one of a lot of volume and continuing to be some evolution, but nothing compared to what we've gotten to now in terms of market access and the ability to discover prices so quickly. Walk us through the kind of evolutionary points of importance in terms of the advancement of the market. You mentioned data, but also technology. Of course, you're center to thinking about option trading technology. What are some of the things from a timeline perspective that you think have been really impactful from getting the market from the year of 2000 to the year of 2022?
Well, another one of the worst trades, I mean, it's funny how you remember your worst trades, was in Amazon. And there was so much volume that the stock got behind the options. And my trader in there just got flooded with all these calls, and everyone knew the market was below it. You were getting hit on raise, or the wheel, people call it. And so, that thankfully doesn't happen anymore. But what happened is you just got all these deltas at the top, and the market was really beneath that. And it happened so quickly that the CBOE wouldn't even let us out of that. So it was a mess, and you don't get those as much anymore. I still think that it's tough not having people on the floor because we had to stand up to the markets. One of the things I saw during the COVID crash, we have this market width analyzer, and that really got wide. I mean, you couldn't, especially in some of these, Russell 2000 stocks. So we measure the weighted total of the market width, and it got so wide, we couldn't do that on the floor. We had a fast market for maybe 20 minutes or something like that, but then we had to tighten it and stand up to markets. Now what's happening, I think, is these market makers, they've gotten so sophisticated. And so in order to fight off these other people that have such good information off the floor, they're just widening their markets. And you can understand that they're doing that, but it's also, if you're a retail trader, those markets stay wide for days. And so retail can't really trade that, and they don't know the prices. So one of the things that my firm does, ORATS, is that we have a smoothing price so we could have a valuation, a theoretical valuation, to help out people using our software. So like, here's the value, even though the market's $1 at $5, the theoretical value based on where it has been and where the smoothing and other good markets are is this. So there's still some of the same problems, even though the technology has gotten better, that you have now because there aren't as many market makers and as many people that are having to stand up and make quality markets. We couldn't go that wide back then, and we had to stand up to a certain market. So there was more discovery back then. Obviously, it wasn't as quick to change as they are now, but there are some good points and some bad points about how it's evolved, Dean.
Well, part of that is decimalization or pennies. That was a big kind of move from eighths and teenies and that sort of stuff to penny-wide markets. And it would seem that it's following to a large degree what's happened in equity markets, which are more trades, more volume overall, but just in much smaller increments. And it seems as well, I think this is where you're going. I'd love to get further thoughts from you on this, that the pools of capital that are essentially a part of price discovery and taking down risk are really dispersed. Maybe they're not as big, but there's just lots of them and maybe they're smaller. How do you think about just the kind of setup for the supply of volatility risk or the people that buy options versus 2 decades ago? What does it look like now versus then?
Well, the good thing back then is I developed a healthy fear of the market and knowing that people knew more than I did. People would come in at earnings time and they would always be on the right side. And then from another perspective, they'd be buying vol at exactly the right time. So I think that there's so much information now in the market that one of the things that we do at ORATS is we try to identify where those pockets of volatility information is. And I really enjoyed your call with Campbell Harvey because he would talk about identifying the factors that were important. We do that on a smaller scale with volatility. We'll look at contango. We'll look at forward volatilities. We'll look at correlations between the components and the ETFs, for example, of volatility. So, for example, with forward volatility, this is hopefully interesting to some of your listeners, that there's a calculation for forward volatility of the implied volatility, let's say, of a 30-day and an implied volatility of a 90-day option. So the volatility that's implied between the 30-day and the 90-day is some volatility. That's the forward volatility of the 90-30. And we also do a calculation. You could do that calculation with a formula. And we also do a solving calculation where you make a time spread and you solve for that volatility. And those are often very close. So that we call it a flat volatility. So they both have to have X volatility in the 90-day and the 30-day to be able to solve for the theoretical value that matches the market. So that sounds fine, but like what we've noticed is that when that relationship between those two factors, the formulaic and the solved flat vol, get out of whack, that shows that usually some market duress is coming. So we found that to be an interesting factor. So what I'm seeing is there's just some very smart people out there. And if you can try to identify what they're doing, because they try to obfuscate their trades often, but if you can find the important factors and important measurements, which is what we try to do, we have now, I don't know, over 1,000 different indicators that we test. If you could find the important ones and start to learn why and learn when you can start to see them turning, for example, that could really help some of the strategies that you have. So my assumption is that there's some very smart people out there. My other assumption is that they're trying to obfuscate where they're trading, but I also think that you could see it in some of the data and you could also test it, and your testing, your machine learning could figure out what that is and then look at it and try to use that in your trading and timing for your strategies, if that makes sense.
Yeah, we'll talk more about the variety of metrics that you guys have developed and the backtesting service that so many seem to be using. I want to talk a little bit about GME, GameStop, from almost a year ago. I think it was the VIX spiraled to 37 on January 27th of 2020. And it's a remarkable event because it's a stock spiraling higher that really became almost a systemic risk problem. I mean, a VIX doesn't get to 37 by accident. It clearly spilled over so substantially. And if we go back to the late 90s, 1998, and we think about long-term capital as also a systemic event, And just think about how different these two things are. Both sourced in options. LTCM would call up a dealer like a Lehman. I covered them when I was at Lehman. And they'd say, I want to sell 5-year straddles on the DAX or the S&P or the Nikkei. And boy, they would sell an awful lot. They say it was roughly $80 million of Vega, very long dated Vega at that point in time. But it was all over the phone, one off, one counterparty to another, and extremely long dated. And here, the GME, you have this, there's no one counterparty. There's thousands and thousands of individuals like you and I buying 1 and 2 options at a time. And they're buying very, very short dated options. And that spills over and that becomes a thing. They're just so remarkably different. Just as someone who knows so much about options and the technology aspects of it and the trading of listeds, walk us through what you were observing at that point in time a year ago as this event started to unfold.
You're mentioning another stock I lost money in, Dean. So you're 4 for 4.
I'm sorry.
As someone that knows a lot and has a ton of respect for the market, even GameStop, some of those calls, I go, there's no way it's going to hit 200. And the premium in there was insane. I could still remember it was something like the 26th of January. And the next days it just popped. Luckily, I just said, I'm just going to turn it over and do the opposite of what I think is logical. And that's how I made the money back. But these are insane markets. Those are people just buying. Give me a strike, add some more strikes. We're buying it, we're buying it, we're buying it. And that's where I wish I had some more respect, or the old respect that I had. But at some point, it just got crazy. But that actually blew my mind. I just couldn't believe that these stocks were moving that quickly. I mean, it was as violent as that Amazon trade, where you'd be looking at it at one price, and then it would be $100 higher. How do you trade that? I developed a lot of empathy for the market makers at that point. But that, Dean, that is something I don't know that we're going to see that again. We likely will, but that was something else.
It was really, and I think you're pointing to it, when something like that just gets to a certain point, the what ifs, because every previous what if got blown through 200, 300, 500. And I want to say the 1 month vol was 550 or so and well worth it. I think the 1 week vol, I remember looking at the screens, it was in the 800s. And again, probably well worth it just given the magnitude of the moves. But what's fascinating to me, I don't know how closely you've looked at this, but there was an interview in the aftermath, in the sort of days in and around this event, and a lot of controversy too, with respect to Robinhood and Citadel. But Thomas Petterfy, the founder of Interactive Brokers, gave what I thought was a really compelling, almost warning that this really got close to being something that would have been an epic market failure. Again, a stock gets to the 500s and the vol is in the 500s. That distribution, as you know so much about, to the upside, 2000, certainly possible. That's what 500 vol is. And that's just telling you that the degree of the short squeeze already in place just could become really a market failure. And that's what Petterfy was essentially saying, that if you have enough people exercising these options, there's just not simply nearly that amount of stock to deliver. And then it's just make up a price.
I agree with that. We actually had to change our rules on how high we would let implied volatility go before we thought it was an error. It got up to 1,000 in GameStop. There's an argument who was the best basketball player. Is it Michael or is it Wilt Chamberlain? I think it's Wilt Chamberlain because they had to change the rules of basketball after he started playing and dominating so much. In GameStop, when they started changing the rules, I mean, that was one of the most incredible events that I'd seen. So I agree with Petterfy. And we had to change the way that we calculate implied volatility and let it go up to 1,000 now. So, I mean, I think GameStop was something else, Dean.
Sort of the opposite side of what happened in crude, where in, I guess, April of 2020, crude getting to negative, and none of the options models could handle that in the period before it, at least. It's really fascinating. And so there's this huge presence of retail in the markets these days. They're democratized. Let's hope it doesn't end really badly for some folks. It seems more than anything, they're option buyers, not sellers. So you can certainly blow up buying options, but at least you know what you can lose in advance. How have you watched these markets evolve in this post-pandemic period where it seems that everyone's got a Robinhood account? How has it possibly manifested itself just in terms of you and your partners looking at these prices day to day. What's different in the last year and a half?
So I'm looking at the skew of the 5 delta 30-day option versus the 75 delta 30-day option. And we have it weighted average for all the 2000 Russell. And that skew has changed. It's gone from what we would consider normal, maybe the 5 delta might be 80% of the 75, to now it got as high as almost 2.0, almost double. If you can imagine the implied volatility of the 5 delta, double the 75. So usually in the SPY, you might see a 22 vol for the 75, and you might see a 12 vol for the 5. Now, in some of these stocks, these smaller stocks, it has changed the skew, and you could see it in this graph, this historical graph. We go back to 2007, and right after that GameStop, a lot of these stocks have just bumped up, and it's continuing, and now it's above 1 now. Whereas, like I said before, it was about 80%. So what we're seeing is that the retail effect, the Robinhood effect, is lasting. I don't know if it's here to stay, but it's been here for quite some time. One of the things that we do at ORATS is we provide that smooth theoretical values and other types of theoretical values. And we are being approached by some of these Robinhood type firms to help them and help their constituents, their traders, out with not just paying offers that might be way off the books, but to be able to compare what they're paying to what might be a more realistic value for that particular option that they might be able to get filled at. They don't need to pay the ask, for example, in these really wide markets, but they'd have some theoretical value to compare it to. So those are some of the effects that we're seeing from this GameStop, Dean.
As you mentioned, these call skews, it's a new thing. You see it in a lot of these stocks, as you're noting. And one of the questions I keep asking myself, and I'd love to get your thoughts on this, is it worth it? In other words, if you think about the concept in equity markets of put skew, we do generally have the sense, especially on the index level, that markets go down faster than they go up. Crash risk is a real thing. We know that by way of the big blow-up events. And so being short and out of the money put is, in a lot of ways, most ways, riskier than an out-of-the-money call, just in terms of the velocity of down moves at the index level. Professional skew traders would say, well, that's true, but it's still overpriced. That implied skew is higher than realized skew. And so I can make some money with the delta hedging strategy of being short put, long call, and collecting that skew and hedging it out. What about now? So if we think about these single stock call skews that now tilt up sometimes, or certainly have at least a smile, and we're seeing these realized up moves. I mean, we saw the violence of AMC and GME and so forth in terms of the up shocks. What's your view on the economics of this skew as it's priced out? Are there opportunities to trade this skew that might have emerged over the last year?
That's a big question, and one of the more important ones, because a lot of what people are using our backtester and our data for are put hedges and trying to hedge. They know they have to be in the market, but they want to hedge their market participation somehow. And I think that's the most difficult thing. But I think it is important to understand skew. First, just to answer your question, I think it's overpriced, but it's overpriced because a lot of people want it. So, I mean, how do you think about that, right? It's overpriced versus probably movement or those realities, but, obviously supply and demand pin it where it is. But where I think there's the opportunity is you can't just be a buyer at any price at any put. The way that you have to protect your investment, and I'm very much a fan of that, is you need to find places that you could sell put, and you need to find places where you could buy put. And personally, I have those at different places at different times, from the longest dated one, 600 days in some cases for me, way out of the money, to shorter dated. And even a 10-day 10 delta could be long, but then a 30-day 20 delta, that might be short. I mean, I think the way you need to be in the put market, and again, I agree with Campbell Harvey on that puts are incredibly important part of investing and has a place in almost any portfolio. But you have to do it in a way that you have to see this really, I think, overpriced skew, but be able to trade around it in some respect.
One of the nice results is, I think, that for the more conservative investor who wants exposure, let's say, to a single stock, we know that implied volatility is pretty high, but you can use this call skew to your advantage. You're getting paid more for that out of the money call these days, certainly relative to 2 years ago. So the economics of trades like call spreads, I think in an environment where equities are by most counts elevated and susceptible, I think that becomes a nice alternative for investors to consider where you have defined loss, which I think really opens up the realm of possibilities for investors. Let's talk about ORATS and just in your business, how it's evolved over time. I mean, you've got a lot of components to it. I feel like I'm interacting with just one of them. Walk us through a little bit about just in terms of the time frame under which you founded it and just the different ways in which the service has evolved over time.
Well, yeah, it's great to have you on board, and I appreciate talking to you about it. We really started ORATS when I was trading. We were developing those type of tick volatilities and skew calculations, and we'd even do forecasts based on regression analysis and all the forward analysis information that we have. So the floor traders really would see us looking at all this information, and they were our first clients back in 2001. And then the trading firms then started getting into it. And then some of those traders went to banks and they would bring them over. So we got these large banks in. And then we started the backtester just to prove the efficacy of our proprietary data, like the tick data. But then that kind of grew and got a life of its own to where we had banks and especially pension funds, because a lot of people were coming in front of pension funds and they'd have these different strategies. In our backtester, you could test them and they could go back to the people that were coming in. And so you got pension funds to look at them. So we've evolved over the years. And then once you get a backtest, you want to implement it somehow. So we've worked with APIs in order to implement the trades. And we also have risk analysis, because obviously that was big when I was backing traders. So we have a lot of analysis and tools along those lines. We also have machine learning. We mentioned these triggers. So that's what we're working on now is once you get a strategy, can we time it? Can we look at the best times to, for example, maybe selling a put spread against long puts? Can you see something in those indicators to find the best times to get in and get out of those types of trades? Also, I mentioned our fast smoothing of the entire options markets. There's over 1 million options now, and we're going through them, second, and putting all of our ORATS data, our implieds, and putting all our theoretical values on there. So we're trying to get faster. We're trying to help our clients get the back tests, implement the back tests, and then review how they're doing. So that's basically where we are right now. We have ancillary information like dividends, like we do a lot of solving for dividends and implied dividends. So that's been a business that we're in. And clearly having all these different calculations and using them as triggers, that's been a longer business. The backtester, now we're coming out with stock scanners that could then interact with the backtester and interact with the option scanner. So there's a lot going on, and I have a great team, and we're looking forward to more years of doing this.
What I find interesting and really unique about your backtester is that you're dealing with actual market prices. In the world of backtesting volatility strategies, it's typically about getting vol data. Hopefully it's really well curated and scrubbed, and then synthesizing option prices via Black-Scholes or something like that. And I don't think it works that well. I think that there's just too many times where you notice that, oh, wow, this is what my Black-Scholes told me. And this is, now I'm looking at the actual put price on that day from the market, let's say from the S&P, and there's differences that add up along the way. So for you, you're going directly to market prices and just trying to synthesize a trade that is as close to the parameters as possible. Was that a approach that you decided to go down right away, or what was your kind of rationale in terms of getting right directly to market prices?
Well, it's a great point, Dean. And yeah, from being on the floor and even testing our tick data with stock, there were so many things that we had to scrub and adjust. And you could imagine that's even more so for the options. So luckily, being a past market maker, I know where the markets are realistic and unrealistic. We spend a lot of our time on that, we call it SMV system, smooth market values. And we're continuously rating the markets. So like we have a confidence number. And you have to simulate what you can actually do. That's the most difficult part. I see backtesters that shortcut, and you just can't do that. And not only do you have to have real markets, but you have to have real markets with valuations on top of them, because you could have a market no bid at $2 and it's worth 2 cents. And if you trade at mid-market, that's $1. I mean, that will totally throw off your backtest. So we put all that in there. We put the valuations where you'll get filled. We have commissions in there. We have slippage in there. We have different slippages for more legs. Like just from trading ourselves, it's about 75% that you could usually get filled. But if you have a iron condor, 4-leg, it's about 55% where you could get filled. So we have these assumptions, and you could change those. But I mean, that makes the test, because if you don't have the accurate simulations, you're not going to get the accurate tests. And backtesting already has quite a few assumptions on there. And there are some people that don't backtest at all. But we try to take all that out. It's very difficult. And this is why putting it up there and trying to help people out by doing this. And people say, I'm putting together a backtester. I go, I hope you're not doing anything for the next 3 or 4 years, because it's a tough slog. So we've put it out there for folks like you to test. And we think it saves a lot of time. And we spend a lot of time getting our assumptions correct.
Backtesting is this discipline that I think we all have a love-hate relationship with. It's clearly necessary, but it's certainly the case that people fall in love with the beautiful backtests. There's a quote I often use from a risk officer at CalSTRS who said, "You'll never see a bad backtest ever, because the bad ones you just throw away and you move on and you try to find the good ones." And so there's a certain degree of fitting that we're all vulnerable to. We all need to feel like something worked in the past to even consider it working in the future. But one of the things I like to say is there's always a winner to the backtest. I mean, it's just that something's got to do the best. So as you experiment and you've got an imagination and appreciation for the types of things that do matter, but as you think about different tests and overlaying different conditions for backtests, how do you personally get comfortable with this idea that, well, perhaps I've overfitted this. I took it a couple layers too deep to satisfy myself that this relationship was really there?
That is the most difficult part of backtesting. And I encourage everyone in our firm to try to trade some of these. We have a trading club, and we use our data, use our backtests, and we're continuously actually trading them. So that's the first thing. I use my own tools and have been doing it for 20 years now. So there's nothing like investing your own money to watch things and help you learn and do it the right way. And then secondly, we do out of sample testing, we do forward testing, and then the forward trading. And again, you could learn a lot doing that. That's how we tested out our tick volatility system on the floor, is you would compare the results that you're getting to actual what you're seeing in the markets. Again, I get the knocks on backtesting, but I think in some respect, everyone's doing some type of backtesting, whether it's in their mind or whether they're using a very sophisticated backtest. So that's how I look at it, Dean.
Without diving into anything that you consider proprietary, are there a couple of relationships or trading conditions that you can impose upon strategies that you've found have been especially fruitful? I know you talked about things like implied correlation, changes there. Certainly you've got in your list of indicators things related to earnings days and so forth. Are there a couple you could highlight that you found, well, wow, that's really interesting, and I kind of get the economic logic behind it?
Yeah, definitely. So, I mean, that matters a lot with a strategy. So on our blog, we put up a covered call test where we did 3 million back tests, and we tested things like the best days to expiration, which happened to be around 30, the best deltas, which happened to be around 20, the best, what we call a spread yield, which was very high. So it's about 1 to 2%. So, I mean, the only way or the best way to trade those covered calls were to trade and then also avoiding earnings. So in order to sell covered calls, you have to be getting a lot of money for them. You brought up the point before with that skew. I think that's absolutely correct. If you're looking at things like selling put spreads or something like that, the indicators really help for timing. And we look a lot at contango. We look at the direction of implied volatility. We look at forward volatility relationships in order to determine when it is a relatively safe time to get in. As far as long dated puts, like I said before, I like to buy when the volatility is a little, depending on the skew, very long dated. But then also there's some testing that we've done where maybe 100 days or 200 days is better at certain points, depending on how the contango looks. And there's also how to monetize those. I mean, that was always a very difficult thing, even for market makers. When you made money on that, how do you monetize that? We had this 20% rule that we'd take 20% immediately. We'd take 40% kind of when we thought before we made the rule before. And then we'd have another 20% to do by feel, and we'd leave 20% on. So at least we had some rule, who knows, but monetizing these. So we test that monetization when we test these strategies. So we have exit strategies based on delta, but exit strategies based on profit. So often we'll have exit when you have 200% profit, exit when you have 300% profit on these puts. So that's a really important thing to know going in, when to monetize those, because obviously you can miss the whole move or you can monetize too quickly. And we also have the ability to combine tests. So we could have one put that monetizes at 300%, one that monetizes at 100%, one that monetizes on a delta. And then I happen to use most of those just in my personal investing. And we could combine those. And then that usually smooths things out, because otherwise that's overfitting too, because there aren't that many opportunities to monetize, especially puts. So that's how I think about that, Dean.
Well, when asked by an important client what to do with a winning position, the adept salesperson will always say, sell half, because you're going to be kind of right on both fronts. If it continues to go, at least you didn't get out of the whole thing. And if it goes the other way against the client, well, at least I got you out of half of it. So tell us about, just in terms of what you're most excited about, where perhaps future plans for development. Sounds like you guys are super busy already, but what are the things that are really top of mind for you in terms of expanding and bolstering the product?
We're adding fundamental data, so that's been real neat, and some technical indicators. So we're going to be adding more to our, I love the optimization and machine learning. We use some services like Boosted AI is one company that we work with. It's just unbelievable what they could do. That's real exciting to me, is getting more into machine learning with these triggers that we have. And then I have this dream, and I know this is big for you, is I have price data going back to the 1800s, and I want to make markets every day based on my experience and what the market would have been that day, and then be able to backtest those and show for certain strategies, especially put strategies that only pay off once every couple of years, how that might look. So those are my dreams. Those are my short-term and long-term, but I love getting up every Monday and working with people like you and great clients and great partners that I'm working with. So it's been a lot of fun, and I've been in it for a long time, but I still find it exciting every day.
Fantastic. Well, let's leave it there. Matt, this has been a great conversation. I've really enjoyed it, and I think our listeners are going to really enjoy this podcast.
Yeah, it's been a pleasure, Dean. I really appreciate you inviting me on.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.